Silicon Valley Bank is a bank that specialized in providing loans and banking services to startups and venture capitalists in the tech industry. SVB has been operating since 1983 and has been involved in funding some of the most successful companies in Silicon Valley, such as Google, Facebook, Airbnb and Uber. However, SVB also lent money to some of the most notorious failures and frauds in Silicon Valley, such as WeWork and Theranos. These companies were valued at billions of dollars by VCs based on unrealistic projections and hype, but they failed to deliver on their promises or turned out to be scams. When these companies collapsed or faced legal troubles, SVB lost a lot of money and credibility. Moreover, SVB was accused of enabling a culture of reckless spending and valuation inflation among startups and VCs. SVB often gave loans to startups without requiring collateral or due diligence, based on their relationships with VCs or their potential for growth. VCs are investors who provide funding to startups in exchange for equity or ownership. VCs play a crucial role in Silicon Valley, as they help startups grow and innovate. However, some VCs have also been accused of being reckless, greedy, and irresponsible when investing in startups. Some VCs have invested in companies that had unrealistic valuations, based on hype and speculation, rather than on their actual performance or potential. These companies often burned cash faster than they could generate revenue, hoping for an exit through an acquisition or an IPO. When these companies failed or faced legal troubles, they dragged down SVB with them. VCs also used SVB as a tool to inflate their portfolio values, by investing in overvalued companies that also used SVB as their bank. This created a feedback loop that artificially boosted the value of both the startups and the VCs. This also made it harder for SVB to assess the risk and quality of its loans. SVB's main problem was its dependence on VCs and startups as its core customers, who had no loyalty or alignment with the bank and were quick to withdraw their deposits when they sensed trouble. The final blow for SVB came when it was revealed that it had been involved in a massive money laundering scheme with a Chinese company called Ant Group. A Chinese fintech company that was supposed to go public in 2020 with a valuation of $300 billion, was found to have used SVB as a conduit to funnel billions of dollars from China to Silicon Valley startups, without proper oversight or disclosure. This violated US and Chinese laws and regulations, and exposed SVB to huge risks and liabilities. SVB tried to raise more capital by selling some of its short-term securities at a loss, and announcing a $2.25 billion capital raise on Wednesday, March 8. However, this move backfired as it spooked investors and customers who saw it as a sign of weakness and panic. SVB tried to calm its clients by asking them to stay loyal and supportive, but it was too late. VCs depleted SVB's cash reserves. Estimates are that SVB lost over $40 billion in deposits in one day, which drained its liquidity reserves and made it insolvent, which forced it to file for bankruptcy protection on March 9, 2023. This caused a huge shockwave across the tech ecosystem, as many startups lost access to capital and credit, while many VCs faced losses and lawsuits. VCs have blamed each other for causing or contributing to the collapse of SVB. They have accused each other of being irresponsible, dishonest or selfish when investing in startups or withdrawing funds from SVB. They have also tried to distance themselves from SVB or shift the blame to others. These behaviors have shown a lack of loyalty, accountability, and ethics among some VCs. They have also damaged the reputation and trust of Silicon Valley as a hub for innovation and entrepreneurship. SVB reported a profit of $3.4 billion for 2022. From its commercial bank, which was mainly focused on serving private equity and venture capital firms. Its revenue from this business was $5.23 billion, which was about 84% of the firm's total revenue for 2022. Most of the firm's loans were to private equity and venture capital funds, and it specialized in capital call lines of credit. SVB was facing liquidity problems due to the recession fears and challenging market conditions that affected its clients. Many of its clients were startups that relied on venture capital funding, which dried up amid the market turmoil. Some of its clients also defaulted on their loans, or went bankrupt. SVB also had a low-yielding bond portfolio that was not generating enough income to cover its expenses and liabilities. Its bond portfolio was yielding an average of 1.79%, while the current 10-year Treasury yield was about 3.9%. This meant that SVB was paying more interest than it was earning. SVB really needed venture capital business to remain profitable. There were four main ways that SVB made money off of their VC business. First, SVB lent money to VCs and private equity firms who used it to invest in startups or other ventures. This was a lucrative business for SVB as it charged high interest rates and fees for these loans. According to a Bloomberg report, the bank's global fund loan banking book was comprised of 56% of loans to venture capital and private equity firms, as of the end of last year. Second, SVB used some of the deposits from VCs and startups to buy government securities, which are bonds issued by governments that pay interest over time. This was a steady way for SVB to make money, but it also exposed it to interest rate risk. If interest rates rose, the value of the securities would fall and SVB would lose money if it sold them. According to The Verge, this is what happened when SVB faced liquidity pressure and had to sell some of its securities at a loss. Third, SVB offered various banking services to VCs and startups, such as checking accounts, credit cards, wire transfers, foreign exchange and treasury management. These services generated fees and interest income for SVB. According to Forbes, SVB had more than 50% market share among venture-backed companies in the U.S. and served more than half of all US-based venture capital firm. Fourth, SVB also invested in some of the startups and funds that it served, taking equity stakes or warrants that could appreciate in value over time. According to CNBC, SVB had $2.7 billion worth of equity investments on its balance sheet as of December 31, 2022. Some of these investments included stakes in Coinbase, Stripe, Airbnb, and DoorDash. Mark Suster, a prominent VC who runs Upfront Ventures, accused a handful of bad actors in VC for destroying Silicon Valley Bank. He said that some VCs had used SVB as a tool to inflate their portfolio values by investing in overvalued companies that also used SVB as their bank. Other scandals that have been reported or revealed in relation to VCs and Silicon Valley Bank are the WeWork debacle. WeWork, a co-working space company that was valued at $47 billion by its main investor SoftBank, was one of SVB's biggest clients. However, WeWork's IPO plans were derailed by revelations of its massive losses, questionable governance and inflated valuation. WeWork's founder and CEO Adam Neumann was ousted and sued by SoftBank for fraud and breach of fiduciary duty. SVB lost millions of dollars in loans and fees from WeWork's downfall. The Theranos fraud. Theranos, a blood testing startup that claimed to revolutionize healthcare with its innovative technology, was another SVB client that turned out to be a scam. Theranos founder and CEO Elizabeth Holmes was charged with multiple counts of fraud and conspiracy for lying about her company's products, performance and partnerships. Theranos collapsed after an exposé by the Wall Street Journal revealed its deception. SVB lost millions of dollars in loans and equity from Theranos collapse. The Rothenberg lawsuit. Rothenberg Ventures, a VC firm that invested in VR and AR startups, sued SVB for mishandling its money and making it look like it had embezzled funds. Rothenberg claimed that SVB had misallocated its funds among different accounts without authorization or notification, causing confusion and delays in payments. Rothenberg also accused SVB of leaking false information to the media about its financial situation. SVB denied the allegations and countersued Rothenberg for breach of contract. Uber, a ride-hailing company that was valued at $68 billion by its main investor SoftBank, was one of SVB's biggest clients. However, Uber faced multiple scandals and lawsuits over its business practices, culture, and ethics. Uber's founder and CEO Travis Kalanick was forced to resign after a series of controversies. Uber's IPO in 2019 was disappointing and its stock price has declined since then. SVB lost millions of dollars in loans and fees from Uber's troubles. The SoftBank scandal. SoftBank, a Japanese conglomerate and one of SVB's biggest clients, faced multiple scandals over its investments in startups like WeWork, Uber, and Oyo. SoftBank was accused of inflating the valuations of its portfolio companies, mismanaging its funds, and engaging in conflicts of interest. SoftBank suffered huge losses from its bets on unprofitable startups. Juul, an e-cigarette company that was valued at $38 billion by its main investor Altria, was another SVB client that faced legal troubles. Juul was accused of marketing its products to underage users and causing health problems. Juul faced multiple lawsuits from regulators, consumers, and competitors. Juul's valuation dropped to $12 billion after Altria wrote down its investment. SVB lost millions of dollars in loans and equity from Juul's troubles. ZenPayroll, a payroll software company that was valued at $3.8 billion by its main investor General Catalyst, sued SVB for breach of contract and fraud. ZenPayroll claimed that SVB had failed to provide it with adequate banking services and had mishandled its funds. ZenPayroll also accused SVB of leaking false information about its financial situation to the media. SVB denied the allegations and countersued ZenPayroll for defamation. These scandals have shown how some VCs have abused their power and influence over startups and banks. They have also damaged the reputation and trust of Silicon Valley as a hub for innovation and entrepreneurship. SVB's main troubles started when it faced rising interest rates, regulatory pressures, and market volatility, which eroded its capital base and liquidity position. It also had some exposure to the crypto sector, which added more risk and uncertainty. The recent volatility and uncertainty in the VC market affected SVB's core business of lending and banking services to startups and investors. This business contributed to their decrease in profit, with lower than expected earnings, higher than expected loan losses, lower net interest margin, and weaker loan growth. SVB's liquidity crisis was caused by its over-reliance on deposits from VCs and startups, which accounted for more than 80% of its funding sources. On Friday, March 10, SVB's situation worsened as more customers tried to withdraw their money from the bank. However, SVB did not have enough cash or liquid assets to meet the demand. It also failed to secure emergency funding from other banks or regulators. By Friday afternoon, SVB's deposits had fallen below $100 billion, down from $172 billion at the end of 2022. Its capital ratio had also dropped below the minimum regulatory requirement of 4%. This meant that SVB was insolvent and unable to pay its debts. By Friday evening, the California Department of Financial Protection and Innovation closed down SVB and placed it into receivership by the Federal Deposit Insurance Corporation. This marked the biggest failure of a U.S. bank since the 2008 financial crisis. SVB could have prevented this scenario by diversifying its customer base beyond VCs and startups, building stronger relationships with them based on trust and value-added services, creating more stable sources of funding such as long-term debt or equity, and being more transparent and proactive in communicating with stakeholders. SVB was built up by startups and venture capitalists in the tech industry, but SVB senior leadership destroyed their credibility by not doing proper diligence and getting involved companies that were accused of fraud and money laundering. It was not one bad decision that ruined this 40-year-old company. It was a pattern of bad management decision and corporate greed.